You quit your W-2 in July, your last paycheck clears, and somewhere in the back of your head, a voice starts whispering that the IRS is now coming for you every 90 days. That voice is mostly wrong. And believing it is why so many mid-year quitters overpay in penalties they never actually owed. The IRS underpayment penalty rate is running at 7% annualized for the first quarter of 2026 and 6% for the second, per Revenue Ruling 2025-22. And freelancers keep volunteering to pay it because nobody explained the safe harbor. Wait until October to figure this out and you've already burned through 2 quarters of exposure. So let's talk about what actually happens when you leave a job mid-2026 in the order it matters. Start with the piece almost everyone misreads. When you were on a W-2 from January through July, your employer withheld federal tax out of every paycheck. The instinct is to say, okay, that covered January through July, and now I'm on my own for August through December. That is not how the code treats it. Under IRC Section 6654, W-2 withholding is deemed paid evenly across the entire tax year, no matter when it actually hit. 6 months of withholding gets spread across all 12. And that one quirk, buried in the IRS's own FAQ on lump sum distributions, is the single most powerful lever a mid-year quitter has, because it means the money your old employer already sent to Treasury can shield freelance income earned in November. Here's how you actually use it. The prior year safe harbor, straight out of IRS Publication 505, says you will not owe an underpayment penalty if your total 2026 payments, withholding plus estimates, hit 100% of your 2025 total tax. If your 2025 adjusted gross income was over $150,000, that number bumps to 110%. Look at line 24 of your 2025 Form 1040. That's your target. Not your 2026 tax, your 2025 tax. Doesn't matter if you 10x your income as a freelancer this year. As long as your withholding and estimates cover that prior year number, the penalty is 0. You settle the actual bill in April 2027. So the real first move the day after you quit is not to panic schedule a quarterly payment. It's to pull last year's return, find line 24, subtract what your ex-employer already withheld in 2026, and see what's left. Sometimes the answer is nothing. I've had freelancers walk in convinced they owed $4,000 in September estimates when their July quit withholding had already cleared the safe harbor by August. Your bracket, your filing status, whether you're married to someone still on a W-2 who's also withholding, all of that changes the math, so run your own numbers, don't borrow mine. But the framework is the same for everyone. Safe harbor first, then decide if you need to send anything. Now, if your withholding is short of the safe harbor, say you quit in March, not July, you've got a second trick. Because W-2 withholding is treated as paid evenly, you can also ask a new employer, or a spouse's employer, to withhold extra in Q4 and it still gets spread back to Q1. That's the December catch-up move. It doesn't work for estimated payments, which are dated when you send them, but withholding is magical that way. Honestly, I think most advisors get this backwards. They tell mid-year quitters to start estimates immediately when the cleaner fix is often just cranking up a working spouse's withholding for the last 2 months of the year. Let's move to the 401k sitting at your old employer, because this is where I watch people set fire to real money. You have 3 options. Leave it, roll it directly to an IRA or solo 401k, or take an indirect rollover where they cut you a check. Do not take the check. Under IRC Section 3405C, your old plan is required to withhold 20% for federal tax on any indirect rollover. So a $100,000 balance shows up as an $80,000 check. To complete a tax-free rollover, you have 60 days to deposit the full $100,000, meaning you have to come up with the missing $20,000 out of your own pocket, and then wait until April to get that $20,000 back as a refund. Miss the 60 days or fail to redeposit the withheld portion, and the IRS treats that $20,000 as an ordinary income distribution, plus a 10% early withdrawal penalty if you're under 59.5. The fix is boringly simple. Trustee-to-trustee direct rollover. The check gets made out to the new custodian, not to you, and the 20% withholding rule doesn't apply. Fidelity, Schwab, Vanguard, all 3 will walk you through it in 20 minutes. And a small warning while we're here, the IRA 1 rollover per 12 months rule applies across every IRA you own, combined, not per account. That's the Bobro case and IRS announcement 2014-15. Direct rollovers don't count against that limit, which is another reason to just do it directly and stop being cute. Once that money lands, the next question is where to put your new freelance retirement contributions. And this is where the 2026 numbers get genuinely exciting. Per IRS news release IR 2025-111, the 2026 employee 401k deferral limit is $24,500. IRA limit is $7,500. The total defined contribution plan cap, employee plus employer, is $72,000. And a solo 401k lets you capture both sides of that as one person. You are the employee, you are also the employer. You can defer up to $24,500 out of your net self-employment earnings as the employee, and then contribute roughly 25% of net SE earnings on the employer side, all the way up to the $72,000 combined ceiling. Here's the part people miss. You do not need a full year of freelance income to hit the employee deferral. If you quit in July and earn $80,000 of net self-employment income from August through December, you can defer the full $24,500 as the employee, plus a chunk on the employer side. My take is this is the single biggest reason quitters overpay tax in their transition year. They wait until next January to open the solo 401k, miss the calendar year deadline for the employee deferral election, and leave $20,000+ of deduction on the table. Open the account the same month you quit, not December, not when things settle down. The same month. One catch-up wrinkle worth knowing if you're over 50. Starting January 1st, 2026, under Secure 2.0, any 401k participant age 50 or older whose prior year W-2 wages exceeded $150,000 has to make all catch-up contributions on a Roth basis. Not pre-tax. Roth. So if your 2025 W-2 was $180,000 and you're 54, your $8,000 catch-up in your new solo 401k for 2026 has to go in after tax. The base $24,500 deferral can still be pre-tax. Just the catch-up flips. This matters for cash flow planning in a year when your income is already lumpy. Now the piece that genuinely rewards the switch to freelance. Section 109-90A, the Qualified Business Income Deduction, got made permanent under the One Big Beautiful Bill Act, and starting in 2026, it comes with a guaranteed floor. Per Thomson Reuters summary of the OBBBA changes, any taxpayer with at least $1,000 of QBI from an active business in which they materially participate gets a minimum $400 QBI deduction, inflation adjusted going forward. Above that floor, the standard 20% of QBI applies. The taxable income thresholds for 2026 sit around $201,775 single and $403,500 married filing jointly, with expanded phase-in ranges of $75,000 and $150,000 respectively. Under those thresholds, you just get the 20%. Clean. Run the number. You quit in July, you earn $30,000 of Schedule C freelance income from August through December, and your total household taxable income comes in under $201,775. Your QBI deduction is roughly 20% of $30,000, or $6,000. Straight off your taxable income. That's real money for filling out a couple of contracts and invoicing on time. Your specific number depends on your bracket and whether you're in a specified service trade. Consultants, lawyers, and financial advisors phase out faster than a graphic designer or a plumber. So check your own category, but for the vast majority of mid-year quitters, this deduction just shows up. Self-employment tax is where the last big surprise lives, and it's a good one. Freelancers panic about the 15.3% SE tax because there's no employer covering half. Fair. But if your W-2 wages before you quit already hit the 2026 Social Security wage base, $184,500 per the SSA COLA fact sheet, then your subsequent freelance income owes only the 2.9% Medicare portion, not the full 15.3%. Your prior W-2 FICA withholding gets credit toward the Social Security cap, and once you're over it, the Social Security half stops. Medicare has no cap, and the additional 0.9% Medicare surtax under IRC Section 1401(b)(2) kicks in on SE earnings above $200,000 single or $250,000 joint. But that Social Security shutoff is a real quiet win for high earners who quit in the second half of the year. 2 more housekeeping items and then we're done. First, the 1099 reporting thresholds changed. The OBBA reversed the phased 1099K drop and restored the original threshold. You only get a 1099K if you had more than $20,000 and more than 200 transactions on a platform. The $600 threshold is dead, and the 1099 NEC threshold for contractor payments went from $600 to $2,000 starting in 2026. That does not change what you owe. All your income is still taxable whether you get a form or not, but it changes what shows up in the IRS's matching system, so keep your own books. Second, since I work with 1099 earners on tax and retirement strategy, the mistake I watch bite hardest in transition years is treating "just write it off" like a magic phrase. Home office mileage at 72.5 cents per mile for 2026, health insurance premiums, the solo 401k contribution itself, those are real deductions under Section 162 and Section 109.A when you document them. But you have to actually run a business, not just call things business expenses because you bought them after July. Keep a separate bank account from day one of freelancing. That single move makes the rest of this survivable. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this cleared up even one piece of your mid-year switch, subscribe. I publish one of these every week specifically for people navigating 1099 life without an employer safety net. And if there's a specific freelance tax scenario you want me to walk through, end to end, drop it in the comments and I'll pull it into an upcoming video. Next week, I'm digging into the reasonable compensation problem for S-Corp freelancers, what the IRS actually expects you to pay yourself as a W-2 wage, and what patterns are getting flagged for audit. That one's going to save some people a lot of money. See you then.